Economy rolls over, stocks hold up. Or vice versa. Stocks hold up, economy rolls over. Can those things happen?
Good morning, Alex. Now, I mean, look, I think if the economy rolls over into recession, then it's very unlikely stocks will hold up. That's not priced. And the reason why it's not priced is because we don't know the answer yet, right? I mean, there is an opportunity for the Fed to perhaps orchestrate a soft landing, meaning no labor cycle. But that's where we differ, I think, from most people, which is if we don't get a labor cycle because companies are hoarding labor, that's actually going to be worse for margins in the short term. And then secondarily, if you don't cleanse it, you don't really have anything to get excited about. There's no reacceleration then for growth next year. So as bearish as we are on kind of earnings in the near term, we're actually probably more bullish than most on 2024 because we think we're in this, boom, bust, boom environment that we've been talking about for the last several years. And you can't have your cake and eat it too, right? You can't say, oh, well, I'll just look through this valley and then play the next boom. Well, I mean, that's not really, advised. I think if you agree with our earnings call next year, then you almost have to agree with our earnings call this year, and the market won't look through that.
So in terms of how you think this is going to play out, you think this is a near-term phenomenon. You think this is going to happen soon, Mike. Yet at the moment, I'm looking at the soft data rolling over. We're going to get the PMIs tomorrow, but I'm looking at the hard data holding up. I'm looking at the employment data in particular holding up. So which piece of data is going to get the markets to pay attention on the economic front and mark stocks lower?
Yeah, I mean, what it always comes down to is earnings. I mean, earnings is the hard data series that drives stock prices the most. I mean, we've always said that, and we continue to believe that. So we're just trusting our process, which is that, the leading indicators for the hard data is soft data. And the soft data has rarely looked this weak. So you have to be basically assuming it's different this time for the hard data not to follow. And, that's not a position that we want to take, particularly given that we just had a rally over the last 3 months, which has been spectacular. We sometimes get coined with being perma bears, but last time we called for that rally in October, and we basically got chased off the screen then. So, what's amazing to me is very few people wanted to play that rally in the fall, and now people want to play it after it's already happened. And the last thing I would say about that is what people are getting most excited about are three things. Confluence of China reopening, which is good, and we agree with that. Secondly, gas prices have come down precipitously in Europe, which is maybe keeping them out of a recession, at least in the near term. And then you have the hope for a Fed pivot, which is also our call, that the Fed's going to pause after this next meeting. But the problem is you already priced all those things. The valuation now does not reflect the earnings risk that we still see in the U.S., which is not going to change from any of those three developments.
So, Mike, on that point, Evercore had a note over the weekend that said that a China reopening is in the early innings and could unlock $1 trillion worth in excess household savings. Either you disagree with the number or you think that that's already priced, that amount is priced.
Well, first of all, there's a timing to that. Okay, so there's, $1 trillion is going to come out in the next 3 months. Number one, our intelligence and our sources would tell us that consumer confidence in China is still very fragile. So, yeah, they're reopening, and that's a good thing, and it's going to get there. But the average consumer is still skeptical. They're still a bit scared of the virus, as they should be. They don't know how it's going to play out. There have been increased death rates, et cetera. So it's going to be slow. So that's number one. Number two, I would say, and we've done work on this, we think China's reopening is good for China. It's going to be very good for the Chinese stock market. We're bullish there. But it's not going to necessarily drive revenue and earnings growth in the U.S. And that's what I was saying earlier. China basically is 3% of the S&P 500 revenues. So, even if it is a faster reopening, it's not going to move the needle in the short term.
I guess by extension, it might, Mike. And hear me out on this. China reopens, good for Europe. Gas prices coming down in Europe as well, probably add some wind to the sails. European stocks have been massively outperforming. Everybody floods out of the US equity market into the European market, into the rest of the world, basically. Can I kind of join those dots together, do you think? Or do you think that trade has already worked?
Well, no, but that has been our call, right? We've actually centered on Asia as opposed to Europe as the place to be. But the charts don't lie, right? I mean, they basically are showing the relative strength in EM over S&P as well as Europe over S&P, which is the first time in recent memory that that's happened, and that's real. We think it's a function of a couple of different things, Guy. Number one, exactly what you said, the relative growth profile maybe is improving outside the U.S. But number two, in October, the big tech stocks, almost all of them had a really difficult time with earnings, and the stocks came down sharply. And we think that money is now being reallocated around the world, and that could be persistent. That could take years for that capital to be redeployed in areas of the market, global market, that are much more attractive on a relative basis now.
So on that sense, for U.S. tech, how much money do you think still has to come out of those guys?
Well, we don't know, obviously, but what we do know is that the capital concentration that's occurred over the course of the last really decade has been somewhat unprecedented. Maybe the tech bubble was the only other time. So it'll be persistent, okay, particularly if relative strength continues to underperform. And if you just look at those charts, because you did start off this presentation by looking at technicals, I mean, that's probably the strongest technical I can see is the relative underperformance of that sector compared to everything else. I mean, it's the mirror image of what we've experienced in the last 7 years. And to think that that's all completed now, I think would be naive.
Okay, well, let's wrap it up with the technicals. What do we think about those October lows? Do you think we go through them? Do you think we have formed a base with them? What is it for the S&P? 3570, circa somewhere around there. Mike, do we go through that, or do we hold with that?
Yeah, I mean, our fundamental work would suggest that we will take out the October lows. I think at a minimum, we will retest those lows. Because what we don't know, Guy, is probably two things, is we still could have other policy support dynamics. We're hearing about now fiscal stimulus perhaps coming out of Germany and France in sort of a coalition. That could be a positive. The Fed could pause, maybe even cut rates. We'll see later this year. That could be an offset on liquidity that has been a headwind. So, but we think that at a minimum, you go down and retest those lows. Our base case would be 3,300. If it got really nasty, it'd be 3,000. And here's the best news I can give you. If it's going to happen that way, meaning the bad outcome, it's going to be early. It's going to be early part of the year. It's not going to be the second half of the year. If we make it that far, that means we probably did orchestrate a soft landing. At that point, the earnings growth will be turned back up again, and we can look forward.